West Mercia Supplies Pensions Joint Committee. My name is James Walton, Director of Resources and State Council for the Council and the Treasurer for this joint committee. The agenda starts with the election of chairman. So can I have any nominees for chairman for the ensuing year, please?
Yeah, if I can, James, if I can propose William.
That's second, William?
Yes.
Okay. If we're happy on that basis, then I'll now hand over to you, Graham, as the chair for the remainder of the meeting. Thank you.
Thank you, James. Apologies for absence. We have apologies from Councillors Lee Carter, Nathan England, Peter Stoddard, Graham Biggs and Adam Kent. Appointment to the Vice Chairman. I'd like to nominate Councillor Hardman, if I could. You have to do that?
Agreed, thank you very much.
There we go, thank you. Item number 4, the minutes. The minutes have been circulated of the meeting held on the 27th of September 2022. I perused them. I don't have any particular issues. Don't know if anybody else does.
I don't have any issues.
So we'll move the minutes as agreed. Great. Any public questions, Emily?
No.
Okay, thank you. Disclosable interests, I have none.
No.
No, great. Over to you, James. Statement of accounts, please.
Thank you, Chair. So there are 3 main papers to come now, paper 7, 8 and 9 on the agenda. The first one looks back, the second one looks at the current year, and the third one looks forward. So if we start with item 7, which is the statement of accounts. So this is the statement of accounts for 22-23 for the West Mercia Supplies Pension Joint Committee, and includes an annual governance statement. So Appendix 1, we have the statement of accounts, and Appendix 2, we have the annual governance statement. Members will recall that the pension liability for West Mercia Supplies was separated out from West Mercia Energy a couple of years ago, and the set of accounts now just reflects the financial position, the accounting position for the pensions for the previous West Mercia Supplies, which includes some of the members, that some of the officers that have continued working with West Mercia Energy. Because it is purely showing the pension liability, it will therefore vary when we have an actuarial valuation undertaken, and those variances can be quite large. It also includes the costs of managing the joint committee and the arrangements in place between the 4 authorities, and sometimes those items can be quite small. So in item 6 of the cover paper, it pulls out some of the main variances this year. Due to the valuation, the income and expenditure account balance has shifted by just over 4 million, just over 4 million pounds. Last year it was only £500,000, and that is in relation to the net liability that's shown in relation to the pension costs. There is also an adjustment for moving from £4 million. There's an adjustment then for just over £1,000, which relates to the reconciliation of the legal authority costs, and that's just showing as a debtor and a creditor, depending on which part of that calculation it reflects. The annual accounts are not separately audited, but do form part of Shropshire Council's accounts, and therefore picked up as part of the external audit of those accounts. The annual governance statement has been provided to demonstrate the governance arrangements that are in place for the joint committee. So I'll stop at that point, but I'm happy to take any questions if there are any. Thank you.
Adrian?
I don't think I have any burning questions, James. I mean, it all seems to be pretty straightforward to me. As you highlighted in your introduction, this is slightly surprising, the variance that you go around with. The only question I had was just as a percentage, is the scheme fully funded or not?
So through your chair, overall, the Shropshire County Pension Fund is now, I think it's 99% funded, very close to 100% funded overall. Each employer has different funding levels depending on their particular arrangements. When this was, when WMS Pensions was separated out, it was separated out at fully funded. So any implications of that would therefore not be shown within these figures, but that it will vary each year. Overall, the answer is yes, it's fully funded.
Right. Well, we have recommendations 2.1 to consider the finalised statement of accounts to be signed by the chairman and the treasurer, and to consider the annual government statement. I'm happy to move them.
Seconded, Chairman.
Thank you. That's done. Thank you very much. So if we move on to item 8.
Thank you, Chair. So item 8 is titled the pension liability charges for 23-24. So this is for the current financial year, and it sets out the basis for 4 elements which make up the pension liability charges. These are listed in section 7 in detail. So part A is deficit recovery payments, part B compensatory added year benefits, part C legal authority costs, and part D any other costs. So at the joint committee last year, it was decided, agreed, approved that the deficit recovery payment, this is the pension liability payment that is due for the next 3 years, would be paid in one go, 3 years in advance, and that would provide a reduction in the total that would be charged. So part A is just reflecting that charge is £403,800. The estimate last year was that would be £488,000. So that's actually shown a greater reduction than expected. So the benefit of paying up front has been has increased. As per the agreement, that charge is split 4 ways between the 4 authorities. Part B is the compensatory added years benefits. So this is for the previous arrangements before the deficit liability was built up. When somebody retired, if they retired early, then annual cost would be paid. So those costs just go through the accounts every year. The estimate for the 23-24 year is just over £33,000. So that would be a cost of £8,000 per authority. Each year, an adjustment is done for any under or overpayment from previous years. So there's a small adjustment for that to come through. Part C then sets out the legal authority costs. So these are the costs of the administration of and the running of the joint committee. So again, those costs are there, and there is an adjustment as necessary for any previous year's costs that have varied. The biggest figure within that in total that comes to £14,000. The biggest figure with that is the cash flow or implications for legal authority, which was just under £11,000. So just to explain that very quickly, when the decision was taken in September last year, that the whole of the £400,000 for the pension liability cost would be paid in advance. That was paid by Shropshire Council on the 1st of April, around about the 1st of April 2023. This joint committee then confirms the figures, and then invoices are sent out to the 3 authorities to pay their share of all of these costs, the biggest one of which is that £400,000. So because that 400,000 was taken from Shropshire Council's balances for the first 6-7 months of the year, the interest that would have accrued on it added up to about £11,000. So that is just compensated back. So there's no benefit one way or another. It's just the cost of the cash foregone for Shropshire and the benefit that each authority has had in not having to pay that on the 1st of April, only having to pay it in October. Section D is just for any other costs, and this year there were the costs of the actuary for the valuation, which was just over £1,000, and then there was an adjustment against the previous year. So section 7.5 then just lists all of those four costs out and provides the charge for each owning authority. The cost for each authority therefore comes to £112,845.52. And I just draw members' attention to the last section, section 9, payment mechanism. So as I say, given the cash flow arrangements and to try and keep administration down to a minimum, the invoices for those figures will be going out as soon as the Joint Committee has approved them, assuming that they do. And the request is, the calculation is based on the assumption that all member authorities will then pay those invoices within 30 days of the invoice date. Otherwise, that cost falls on Shropshire Council, and the right has been reserved to charge interest if there's a delay in those payments of those invoices.
Well done, James.
I'll end there. If there are any questions, then please let me know.
Adrian.
I don't think I don't think I have any questions other than to express our gratitude on behalf of the four owning authorities that Shropshire stumped up the money and is now recovering it.
Yes, and I welcome the how it's recovered quickly and the prudence and the approach we've taken.
Yeah,
which we all know the situation we're all in. Right, we have recommendations 2.1 and 2.2. Are we happy to approve?
Great, Tim.
Thank you. Right, on to item 9. Policy decisions.
Thank you, Chair. So paper 9 is the policy decisions for 24-25. So this is looking forward to the next financial year. So the arrangements set out in this paper are the same as last year. The only adjustment is to the first section. Again, it talks through that section A, B, C and D. Section A, which is the deficit recovery payments, because that was paid up front last year, there will be no need for that payment to be made next year. So it's just confirming that. And then it's setting out the arrangements for continued policy around compensatory and years, pensions, legal authority costs and other costs. So this is basically for the Joint Committee to approve, which then means that come the 1st of April 2024, Shropshire Council can continue to pay the costs out as necessary, knowing that then these will be covered later in the year. So it's just to agree that policy for a further year. Thank you, Chair.
Any questions, Adrian?
I don't. I mean, it seemed logical to me.
Yep. Right. We have the recommendations at 2.1. I'm happy to move.
Secondly.
Thank you. That's moved. Scheme of delegation to the Treasurer.
Thank you, Chair. So item 10, scheme of delegations to the Treasurer. These are set out in Appendix A. None of the delegations have changed. They're consistent each year since WS Pensions Joint Committee has been set up. It is purely taken each year so that we have confirmation of the arrangements. Given that we only meet once a year, it's necessary to have a scheme of delegations in place so that should anything happen during the year that requires action, we don't need to call an emergency meeting, and we just make those arrangements to deal with whatever issue may come up. And it's good practice, therefore, each year just to reconfirm those delegations so that we know that they're current for the ensuing 12 months.
Great. Any issues? No, I think it's very prudent and good housekeeping. Happy to move the recommendations. Thank you. Okay, the date of the next meeting will be in September 2024. The date to be confirmed, and therefore I close the meeting.
Hang on. Will it?
1 year.
Oh right, of course.
Just for the
pension. No, there's only for
pension.
Yeah, fine.
And therefore I close the meeting at 10:21. Thank you very much.
Well done.
We'll pause the live stream.
Okay, we're live again now.
Good morning and welcome to this meeting of West Mercia Energy Joint Committee. I'm obliged to inform that this meeting is being live streamed and recorded. I also ask you to please ensure that mobile phones are switched off. I shall now ask members of the committee and officers to introduce themselves. I will start. I'm Councillor William Butler, Portfolio Holder for Finance and Corporate Resources of Shropshire Council and Vice Chairman of this actual committee, and I'll go to my left.
Julie Russell, Operations Manager at West Mercia Energy.
Nigel Evans, Managing Director, West Mercia Energy. Good morning.
Gavin Owen, Business Development Manager, West Mercia Energy.
Joe Pugh, Finance Manager, West Mercia Energy.
Chris Chief Counsel, Worcestershire County Council.
Morning everyone. John Fletcher from WR Partners, the external business.
Ben, would you like to introduce yourself?
Yes, good morning all. Ben Boswell, Head of Environment, Climate and Waste from Herefordshire Council.
Thank you.
Emily Marshall, Committee Officer.
Hey, I'm Colin Bates, Category Lead, Worcestershire County Council.
County Councillor Adrian Hobman, Worcestershire County Council, Cabinet Member for Adult Safety Care.
I'm Barry Hanson, Head of Policy and Governance at Shropshire Council.
One more time, press it on the right one. That's all. Hello, James Walton. I'm Executive Director of Resources at Shropshire Council and the Treasurer for West Mercia Energy.
We're expected to attend remotely our Councillor Graham Biggs, who's hopefully going to be with us by about 11:15. Item number 1, apologies for absence. We have apologies from Councillor Lee Carter, Nathan England, Peter Stoddard and Adam Kent. Do we have any others, Emily?
No.
Okay, thank you very much. Minutes. Minutes on pages 1 to 4. I've perused the minutes. Anybody got any comments? Andrew, you have
No, John.
happy to move it? Yeah, I'll move the minutes then. Do we have any public questions, Emily?
No.
Thank you very much. Disclosable pecuniary interest, I have none. That's lovely, thank you very much. Item number 5, Director of the West Mercia Energy Joint Committee will provide a verbal update in line with the West Mercia Energy Joint Committee standing orders. Nigel, please.
Thank you, Chair. In accordance with our standing orders, which were last approved 12 months ago at this meeting, it states that I will maintain a register which contains records of actions under certain clauses within the standing orders. It also states that the register shall be open for inspection at the meeting, each joint committee meeting, and it also states I'll present a verbal update of any entries made in the register since the last meeting, and I can confirm there's no entries to report, Chair.
That's lovely. That's super, so no action to be taken. If we go on to item 6, statement from accounts 22-23, an annual government statement. James, if I could ask you to present that, please.
Thank you, Chair. I'll give a very brief introduction. Chair, you may want to consider taking item 6 and item 7 together, given it's the external audit report at item 7 around the statement of accounts. So I'll give a quick introduction, and then if we want to also bring in item 7 at the same time, then we'll have a debate around the whole of the accounts. Item 6 itself is the statement of accounts and annual government statement for the financial year 2022-23 for West Mercia Energy. The 3 appendices attached to the cover report. The first appendix is the letter of representation, which is required to be signed to demonstrate that all of the information that's been provided is accurate and correct. Appendix 2 is the actual statement of accounts for the 22-23 financial year, which provides details of income expenditure, the profit for the organisation, and the balance sheet position, along with movement in reserves and the details of the accounting policies that have been applied for the year. And then the third appendix is the annual governance statement. So again, this is provided as part of the accounts pack every year and demonstrates the overall governance framework in which West Mercia Energy works. and provides assurance to the joint committee around the policies and approaches that have been taken within the organisation. Over the last 12 months, the period covered by the statement of accounts. There were no major areas to draw out in relation to the accounts, but there will be some items as part of the external audit review which they may wish to draw attention to. But I'm happy to take any questions in relation to the detail as we work through that. If I pause there.
Sure.
Thank you, Chair.
Thank you, James. Quite happy to take your advice. And has anybody got any questions at the moment? But we can take these together with the external audit. You happy with that, Adrian?
Yeah, I think so.
Yeah. Okay. So if we merge and go on to the external audit, please, Nigel.
Thank you, Chair. I'll just pass this over to John Fletcher from WR Partners who've done their work. John, thank you.
Okay, thank you, Nigel. Thank you, everyone. Morning. I guess the purpose of this section of the meeting really is to feed back our audit findings prior to you as a subcommittee approving your financial statements for the year ended 31st of March 2023. So just to provide you that assurance from our audit work before you do that. The audit findings memorandum that's included in your pack is a follow-up to the audit service plan that we presented in the meeting in March. So the meeting in March and the service plan laid out the work that we complete as part of our external audit procedures, and the audit findings memorandum effectively just reports back on those items. If it's okay with everyone, I'll just very quickly turn the pages on that document and just draw out the salient points, if that's okay. The document it's a working document that is used throughout the audit. So we met back, as you'll see on page 2, we met with management back on the 2nd of August to have our closed meeting with management. The document includes a bit of an audit trail just from the matters that were discussed as part of that meeting, just so as a subcommittee you've got transparency in terms of how those matters were resolved. I can say that subject to approval of the accounts today, we anticipate signing an unmodified audit opinion. So our work has been completed in accordance with the audit plan. On page 3, just documented there the materiality levels that our work was performed to. So the audit report effectively states that we're satisfied that the accounts present a true and fair view to all material respects. And when we refer to material, we've quantified that for the purpose of the accounts of the £835,000 mark. As reported in the service plan back in March, that's based on a 3-year average of turnover, so 1% of the 3-year average of turnover. Clearly, the turnover in the March 2023 accounts was quite a jump from the previous 2 years. So that materiality actually reflected 0.6% of the turnover for the year. Page 4 just highlights where we are. So all the green traffic lights there indicate that our work is complete, subject to anything that comes out of the meeting today, and effectively we'll be in a position to sign our audit reports once the accounts are approved by the subcommittee. Page 5 of the audit report reports back on the risks that were identified and presented to the subcommittee in the service plan. So you may recall when we went through the service plan, there were 3 particular risks that we had identified to focus audit procedures on. Two of those risks relate to fraud risks, and they are defined as significant risks in all of the audits that we do by the international auditing standards that we perform our work to. That's the risk of fraud through management override of control, or the risk of fraud through revenue recognition. At this stage, it's really just to report back that our work's been completed in all of those areas, and there's nothing to report back to you as a subcommittee. Clearly, if there was, by the nature of it, we would have raised it at the time. So this is just the formality of reporting back on that work. The other area that we deemed as an elevated risk was going concern, and that's touched on page 5, but then continues on page 6 in terms of the detailed findings in that regard and a summary of the work that we did. Going concern, as I'm sure you're all aware, is the concept effectively that the accounts are prepared on the going concern basis, and that's on the basis that the organisation can continue to meet its liabilities as they fall due for the foreseeable future. And the foreseeable future is defined really as the 12 months from signing. So 12 months from today's date. We've completed all of our work in that regard. We're satisfied that the accounts are correctly prepared on a going concern basis. And we're also satisfied that there's no material uncertainties in relation to going concern that need to be disclosed in the accounts. The work that we've performed in relation to that is summarised on page 6. Clearly, it's the only forward-looking part of the audit. Most of an audit process is retrospective, so we're reporting on the historic results to the end of March. Going concern is that forward-looking piece, so it's the next 12 months. So we clearly review the forecasts, and we've reviewed those forecasts through to the end of September 2024, which effectively is the 12 months from signing. And we reviewed that from a forecasted profit position, but also forecasted cash flow position, and we're satisfied that there's adequate headroom in the cash flow forecast during that period. We've also reviewed results year to date, compared those to budget, and we can see that the organisation is trading slightly favourably to budget year to date, the August management accounts. And again, that's providing some assurance that the organisation is completing its operations in accordance with the business plan. Okay, on page 7, there's just 2 other matters that arose during the course of the audit that we had discussions with management about over and above those 3 risk areas that were identified at the planning stage. Amounts due to external utility customers, that was relatively straightforward. We've left it in there for completeness, and all of the audit work's completed on that with nothing to report to you. The one that has a larger impact on the accounts is in relation to the pension asset recognition. So historically, the organisation's reported a pension deficit. So in the accounts to 31st of March 2022, there's a liability or a deficit in the company's balance sheet of £264,000. And that was as reported to us by the organisation's actuaries. Because of the change in assumptions that the actuaries have used in calculating the liability or the net position at 31st of March 2023, and particularly the discount rate, which has increased due to the increased bond yields, the overall position of the pension scheme has changed from the deficit position to a surplus position. So effectively, the actuaries reported to us in their report a surplus of £793,000. And that can potentially be recognised on the organisation's balance sheet as an asset. As always with accounting standards, though, it's far easier to recognise a liability than it is an asset, and the tests that you have to meet to recognise an asset are much tougher. So the code, the accounting standards, or the CIPFA code effectively says there's 2 circumstances that you can recognise a pension asset, and that's to the extent that you will receive a refund from the plan, or you'll have a future reduction in contributions. So we did review that with the actuaries. We understand that there are reduced contributions over the next 3 years, and those reduced contributions amount to the £283,000. So effectively, we've recognised an asset on the balance sheet of £283,000 as opposed to the full £793,000 asset reported by the actuaries. So it's a bit of an accounting adjustment, a bit of a book adjustment, but just one to be aware of because they're relatively large numbers on the subcommittee's balance sheets. But just to confirm, effectively what we've done is just cap the asset that's recognised to reflect the known future reduction in contributions. Okay, moving on to page 8. This is where we record any adjustments that come out of the audit. And the only adjustment that has come out of the audit is that cap on the pension scheme asset. So effectively, the total comprehensive income reported to us in the initial draft set of accounts was 2.4 million. We then put the adjustment through as part of the audit to cap that pension scheme asset. That's reduced that total comprehensive income by 510,000 to the amount that you see in your accounts, so the 1.925. It's also worth noting just at the bottom there, that was the only adjustment that, or only potential adjustment that came out of the audit. So there was no other adjustments that we recognised that haven't been put through on the grounds of materiality. Okay, page 9 and 10 then really just summarise where we are in the other matters that we're required to report to you. I won't go into the detail of those because, as you'll see, they're all green traffic lights on there, so there's nothing adverse to report to you on that. I think the key thing really just to say is that there's no significant control deficiencies that we came across as part of our audit to report back to the subcommittee. We don't test all of the controls within the organisation, we just test the ones that are relevant to the external audit process. But as part of that, there was nothing to report back to you. So a clean audit from our perspective, which is reflected in the audit opinion in your accounts, which, as I said earlier, is an unmodified audit opinion. So really, just to round off, just by saying thank you to Nigel, Joe, the team, providing us the information and explanations we needed to perform the audit. And just to confirm to the subcommittee, we did have unrestricted access to all the information we requested. So that's the summary of the audit findings memo, but happy to take any questions on that.
Thank you.
Thank you, Chairman. I was a little surprised by the pension asset recognition. And so I'm a bit far away from the CITFA code of practice on how you could recognise this. Because in effect, by coming up with a figure of, of course I can't find it now, 283,000, you are adding 3 years future reduced contributions together. Now, of course, in my view, one of the slight errors in life is actuaries and the discount rate. So, 2 to 4% over 15 months has been quite a rapid rise in the discount rate, which also reflects, of course, interest rates. But I'm just surprised to see auditors taking what I would regard as being quite a strong forward view. I think this is probably an observational criticism, but I'd be interested in any comments. In the scale of West Mercia, frankly, it is neither here nor there nowadays.
Yeah, and the CITFA code is consistent with FRS 22 and the international accounting standards as well, actually, in regards to its recognition criteria of a defined benefit pension scheme asset. So it can only really be recognised to the extent that you're going to get the future economic benefit from that surplus. And that reduction in the future contributions is that surplus that effectively gets recognised. And you can't recognise anything over and above that. So hence that 510,000 that's been de-recognised from the accounts.
But the liability of the pension scheme still sits with the 4 owning authorities. So should they be recognising this in their account?
In terms of whether or not the pension scheme deficit or asset should be recognised in the accounts, and this is the subcommittee's portion of the overall scheme that's recognised in its accounts.
Okay.
Do you want to come in, James? So, yeah.
I think I'll leave it there.
Yes.
If I can, Chair, it's the overall pension liability in relation to the whole of the West Mercia supplies element was discussed at the previous meeting. This is the element that relates to WME, and I think the point is to try and kind of summarise it is there will be another actuarial evaluation in 3 years' time, and that could lead to a further change in those figures. And so all that's being recognised is the bit that is clear for the next 3 years, and then all bets are off kind of when you then get 3 years down the line, we have another valuation which could find a bigger or a lower surplus or even a deficit in relation to the WME employees that are recognised within the.
Right, so that's helpful to me. So what you're saying to me, so what you're saying to me, of course, is that West Mercia Supplies and WME, in regard to pension funds, are entirely separate entities.
Not quite. Within the WMS pension scheme is for all the employees, including WME. The bit that's shown within the accounts here is that in relation to the 13-14 employees that are within WME. WMS had a whole pension scheme, and there are several hundred people within that overall scheme. That's the overall picture. What was happening in the past was the tail end of the biggest part of that pension liability, which had nothing to do with WME, was being recognised within WME's accounts. So we separated that.
Okay.
So it's just the WME element that's now shown within the WME accounts.
Okay.
Yeah, no, fine.
You're okay?
Yeah.
Can I just actually comment how refreshing it is to see the financial report with all green lines? I haven't seen that for a long time. So thank you. I think that was very comprehensive, and well done, everybody. It's very encouraging. So we've got recommendations 2.1 on page 5 and 2.1 on page 61. Are you happy to move them, Adrian? Thank you.
Delighted to.
And I shall second. Thank you very much. Right, we move on to item number 8, the internal audit. Barry, please.
Thank you, Chair. This report provides a summary of internal audit work undertaken during the 22-23 financial year, obviously up to the 31st of March 23, and it reports on progress against that plan, and also provides my opinion as the Chief Auditor Executive on the overall adequacy of the organisation's governance, risk management and control processes when considering the public sector internal audit standards or guidance as required by the accounts and audit regulations. So final performance against the plan was good, with 87% of the plan being delivered. There was just one audit area, procurement, which has been carried forward to the 23-24 audit year at the request of management. So during the year, there were 4 good assurance opinions during 22-23 in respect of finance, debtors, IT, corporate governance and risk management systems, and a total of 5 recommendations have been made over the 4 audit areas reviewed within the year. There were no significant or fundamental recommendations to bring to the committee's attention, and a management action plan has been put in place for the recommendations that were agreed across those audit areas. So based on the work undertaken and the management responses received, the company's governance, risk management and internal control processes are sound and working effectively, and the Chief Audit Executive can deliver a substantial opinion on West Mercia Energy's internal control environment for 22-23. If we go down to the table cuts across page 5 and 6 of the report, which details the overall assurance opinions and the recommendations delivered during that period. I'd like to thank Nigel and the team for the support during the year in helping us to complete the work within a timely manner. And that's it from me.
Brilliant. Anything, Adrian?
No, Chairman, no red flags, no significance for a couple of required attentions, I think.
Yeah, we have the recommendations as stated on page 76, item 3, which I'm happy to move. Thank you, Adrian. Okay. Distribution of surplus. Sorry, distribution of surplus. Over to you, James, please.
Thank you, Chair. So this paper reflects the overall financial position as a result of the finances for the 22-23 financial year. So the calculation is produced every year from the general fund balance that's held by West Mercia Energy. There's an element of it which is identified as a retention, and that figure for this year is £1.806 million. That retention figure is set out in section 6. So the capital at risk figure is the largest of the two figures that are shown there, and that reflects the increased levels of turnover costs, etc., associated with the energy and gas prices and costs over the last 12 months. When that element is taken away from the overall balance, that leaves £1.433 million for distribution. The basis for that distribution is set out in the formula as at section 5.2, and the table at the bottom of the paper in section 7.2 on page 3 then shows the values that would be distributed to each of the 4 owning authorities, which range from just over £300,000 to just under £400,000 for the authorities. And it's proposed that these payments will be made once Joint Committee is approved in October. Happy to take any questions.
Any questions for James? This is an excellent result. So the time of hardship. So if there's no questions, I will move the recommendation stated in item 2 on page 83.
Yeah.
Thanks very much. We move on to item 10, the risk management update, please, Nigel.
Thank you, Chair. So in accordance with our risk management strategy, I'm to inform the Joint Committee at each meeting of any medium and high risks. And those are set out in the table on 5.4. As management review the risk register formally twice a year, and currently there's 83 highlighted risks. Most of those have got mitigation in place to bring them back to acceptable levels. However, there are 8 risks set out which are determined to be medium or high. The table also sets out where there's a change in the overall status, and you can see risks number 4 and 5 have increased from low to medium. I'll just touch on some of these risks. The first 2 risks relate very much to the energy market, and whilst the market is lower than it was 12 months ago, there's still tremendous volatility in there. So we've left those risks as they were, medium and high, 1 and 2 respectively. Risk 3 remains, which is the risk of a central government policy change or initiative which affects negatively the business. That remains. 4 is relating to performance of a key supplier. So currently we've got the same supplier for electricity and gas. Obviously, their performance of delivering the contract is critical to us. We have seen some issues in quality of service dropping over recent months. The number of it's affected billing somewhat, particularly some new accounts, which is disappointing. But it's been escalated with the supplier, and we've seen some improvements recently, but there's more to do, so we're keeping a close eye on that. Risk 5 relates to any unexpected consequences of a change of supplier. And we've been with our current electricity supplier since 2016, Total Energies. We're moving to Empower from the 1st of April. So as a result of that change imminent, obviously the likelihood of issues has risen, and as a result that risk has increased from low to medium. There's a detailed transition plan in place, and as management we're probably meeting with Empower, the new supplier, on a weekly basis. So we're doing everything we can to ensure that the transfer goes as smoothly as possible. But no matter the risk, certainly the likelihood of an issue has increased due to that. Loss of key staff, I've left that as medium. I was toying with whether we could lower that really. We have brought in 4 new staff, and that helps support us as managers and helps maintain good service levels. But it takes a little while to bed them in really and build up their knowledge. So perhaps we can look at review that risk level perhaps in 6 months' time. But certainly as a business we're a lot more robust than we were in terms of staff. 7 relates to bad debts and delayed payment. I've left that at medium. In terms of our credit control, is still excellent. There, touch wood, there's no bad debts to date. Our cash levels are still, very positive, and we haven't seen any significant delays, despite things hitting the press of how councils are struggling. But no matter that, the risk of delayed payment still exists, so we've maintained that one as medium. And the final one is dealing with suppliers who've got links deemed to be unsatisfactory to customers, so that still exists through certainly our gas supplier. So I maintained that one as medium. So that's where we are, Chair, in terms of risks. Happy to take any questions regarding them.
Okay, thank you. Anything, Adrian?
Well, I was interested in bad debts and delayed payments, and reassured that we're not seeing any slowness of payment. I suspect that if that risk does occur, it could well be more in the academies that we supply.
That was our feeling when we reviewed it probably 12 months ago. Yeah. And we did see a couple that were dragging their feet on payment, but pleasingly we escalated that. Got legal letters involved, and a payment plan was agreed. They paid up to date, and then moved to direct debit. So we thought we were thinking that may have been the tip of the iceberg, but proved to melt away, as it were. So.
And Chairman, if I may just go back to 2, which is our only high risk. I take it though, Nigel, it's extremely difficult to mitigate against this, because it's reforecasting volumes in year. So we built up a portfolio which has an assumption. And I suppose if the worst comes to the worst, then we have to sell into the market.
That's indeed the case. So if on the gas contract, the supplier's got the ability to ask us to reforecast future volumes. If we already set a price for that period, and that liquidation or purchase of volumes, depending which way it goes, is detrimental against the positions we secured, then there is an impact on our prices, which may be above our risk levels. We didn't see that last year. There's been no discussion around it this year to date, but that risk exists.
Well, it sort of leads me on to then if we got the risk levels right in the EGOT, that's a question for later on, I suppose.
I would just add that we're doing, a tremendous amount of work on monitoring the volumes and making sure the volumes we're procuring are what we believe are going to be consumed. It's more difficult on gas than power, certainly, because it's dependent whether it's cold or warm. So, but previously on the gas contract, it was a cash out contract, and that, give us some difficulties in 21, 22, you may remember. So we moved to a different product from April 22. So we ran it for 18 months now, and so far it's been fine. But that risk still exists. It'd be interesting when we return to the gas contract. I don't think that product will still exist. It'll probably everybody be offering cash out, so we're back to where we were. But
wait and see.
What's important is close monitoring of volumes, and we're doing that certainly on a monthly basis, and more so when it's critical with the timing of setting prices and that.
I think it's a bit of a crystal ball moment, isn't it?
Well, you're absolutely right. Yeah.
So
yeah, it's
I
a guess on the weather.
Yeah,
in fact,
absolutely.
It can be a cold winter though. Old Mr. Gilder told me he's about 98. He said definitely going to be a cold winter, boy.
Oh, right.
I don't know what he knows. I don't know, but he did mutter about the moon, which I found a bit worrying.
I'm confident you've got things in place to be able to react quickly enough, if that makes sense, to the market. as we've done previously. And having those conversations with James, what we've needed to. So I'm happy to move the recommendations on page 87, 2.1. Thank you, Adrian. Right, item 11, exclusion of the press and public. To consider a resolution under section 100A of the Local Government Act 1972 that the proceedings in relation to the following items should not be conducted in public on the grounds that they involve unlikely disclosure of exempt information as defined by the provision of Schedule 12A of the Act. So we shall stop live streaming. Thank you.
Seconded, Jim.
Thank you.
Just wait 1 second.